Welcome back, future financial titans, to Alpha Index. Today, we're not just dissecting investment vehicles. We're unearthing the bedrock principles that separate the astute from the merely active. You've heard the terms: mutual funds, index funds, ETFs. To many, they're just acronyms, a linguistic maze in the quest for wealth. But for the discerning, they represent distinct philosophies, different paths to the same mountain peak. And understanding these paths isn't just about making money. It's about understanding the very nature of markets, human behavior, and the often overlooked power of simplicity. Let's strip away the jargon and get to the core. Imagine you want to own a piece of the corporate world. You could buy individual stocks, picking and choosing your champions. But what if you lack the time, the expertise, or frankly, the desire to become a full-time stock detective? This is where the world of pooled investments comes in. First, let's talk about mutual funds. Think of a mutual fund as a communal pot. Many investors contribute their money, and a professional fund manager, armed with degrees and analytical tools, then actively buys and sells stocks, bonds, and other assets on behalf of the group. The philosophy here is active management. You're essentially hiring an expert to outsmart the market. The appeal is clear: delegate the heavy lifting to a pro. However, this expertise comes at a cost. Mutual funds typically have higher expense ratios, fees you pay for that active management. And here's the thought-provoking principle. For all their brilliance, many actively managed mutual funds struggle to consistently beat their benchmarks over the long term. Why? Because the market, in its collective wisdom, is remarkably efficient. Beating it consistently is like trying to consistently win against a supercomputer in chess. Possible, but incredibly difficult. Next, we journey into the realm of index funds. This is where the financial world took a profound turn. An index fund doesn't try to beat the market. It aims to mirror it. Instead of a fund manager picking stocks, an index fund simply buys the stocks that comprise a specific market index, like the S&P 500. If the S&P 500 goes up, your index fund goes up proportionally. If it goes down, your fund follows. The underlying principle here is elegance in simplicity. It's the profound realization that instead of fighting the market, you can join it. Because there's no active management, expense ratios for index funds are typically much lower. You're not paying someone to try and outsmart the market. You're simply buying a slice of the entire economic pie. This strategy isn't about brilliance. It's about humility and the power of consistent, broad market returns over time. It's about understanding that the aggregate growth of human innovation and productivity is a force far more potent than any individual stock pick. Finally, we arrive at exchange-traded funds, or ETFs. Now, an ETF, in many ways, is a hybrid. It can be actively managed, but often, like index funds, it aims to track a specific index. The key difference lies in how you buy and sell them. Mutual funds are typically bought and sold once a day after the market closes, at their net asset value, NAV. ETFs, however, trade like individual stocks throughout the day on an exchange. You can buy and sell them at any point during market hours, and their price can fluctuate based on supply and demand, just like a stock. This offers flexibility and liquidity that mutual funds don't. You can also implement more sophisticated trading strategies with ETFs. The principle underpinning ETFs is accessibility and specificity. You can find ETFs that track everything from broad market indices to specific sectors like technology or emerging markets, even commodities or currencies. They allow you to gain exposure to diverse segments of the market with the ease of trading a single stock. So, how do you choose? It's not about which one is inherently better, but which one aligns with your financial philosophy, your goals, and your understanding of how markets truly work. If you believe in the power of professional active management and are willing to pay for it, a mutual fund might appeal. But critically, ask yourself, what evidence supports this belief over the long haul? If you embrace the wisdom of the crowd, the consistent, compounding power of broad market returns, and the elegance of low costs. Index funds offer a profound path. It's about accepting that good enough is often superior to the elusive perfect. If you value flexibility, real-time trading, and the ability to finely tune your market exposure, ETFs provide a versatile toolkit. They bridge the gap between individual stock picking and broad diversification, offering a nuanced approach for the discerning investor. At Alpha Index, we believe in principles over hype. The hidden wisdom here isn't in finding the next hot stock or the superstar fund manager. It's in understanding market efficiency, the power of compounding, and the corrosive effect of fees. It's about recognizing that sometimes the simplest, most unassuming path leads directly to profound wealth creation. It's about letting the engine of human progress work for you, rather than trying to constantly outmaneuver it. Which path will you choose? The one that seeks to defy the market, the one that embraces it, or the one that navigates its currents with precision? The answer, as always, lies within your own principles. If this exploration has sparked new insights, if it has illuminated the hidden wisdom behind these financial instruments, then do us a favor, hit that like button, share this video with someone who needs to hear it, and if you haven't already, subscribe to Alpha Index for more deep dives into the world of online money making, finance, and the principles that truly matter. Until next time, keep learning, keep growing, and keep investing wisely.